Hi, I'm Larry Shover, Chief Investment Officer of Solutions Funds Group. I'm reporting to you today from the CME Group in Chicago, August 2012 monthly commentary. Today's commentary is entitled The Hows and Whys of Managed Futures. Now, let's consider the average stock and bond portfolio, something that most of us have. If you have something in mutual funds or stocks, you probably have financials, energies, tech, consumers, conglomerations of stocks and bonds all put down together. And by and large, that's a good thing to have because as the market moves higher, moves sideways, it makes sense to be diversified within the space of the stock market and the bond market. However, let's talk about crisis situations, events, calamities. What do you have in your portfolio that will help you through that? Now, I'm going to go to the next slide really quickly here. This is 37 years of stock market volatility, starting in 1971 with the breakdown of the Bretton Woods Act, all the way to 2008 with the credit crisis. What did all of these crises have in common with the stock market? What they had in common was the diversification that you may thought you had within your stocks and bonds really did not work. It may have worked a little bit, but there was nothing in that box to really help you in a severe drawdown, such as what you see on this board behind me. So let's talk about the evolution of a typical market event. What happens during a crisis situation in bonds and equity markets? First, there's severe synchronization of the markets. That's followed by investor panic. People are guided by what they have to do, maybe not what they need to do. And because of that, leverage and risk limits become breached, especially on an institutional level. People who are leveraged in the stock market have to get liquidity. That causes increased volatility and correlation in the stock market. And because of that, liquidity typically disappears because everybody is trying to do the same thing at the same time. Credit issues can and do come at the forefront of everything as everybody's just seeking liquidity in the stock market. Okay, so that's something that typically happens in a crisis situation. Why does this event evolution create persistent trends, and why does that matter for managed futures? Let's look at it. In various persistent trend situations, you have fundamental valuations don't matter anymore. Conventional wisdom becomes absolutely meaningless because there's a feverish attempt to get out of the equity market and to get into cash. Well, that whole scenario right there, that evolution, creates a persistent trend. And why have managed futures done so well in these types of crisis environments? And that's because futures inherently are adaptable and systematic. They're tied to a physical, they're standardized, and they're marked to the market every day. And because they're attached to a physical, people are willing to buy and sell them on a liquid basis because things are marked to market on any given day. You can go long or short with equal ease. That's something that's implicit in a futures contract itself. It's not like a stock where you have to borrow it and hope for the best. In a futures market, they're designed so that you can take a conviction whether bullish or bearish with the same equal ease in the market. There's no borrowing involved. And back to the stock situation and why this happens in crisis. It costs 50% to be leveraged long, 150% to be leveraged short in the stock market. In the commodities markets, we're talking 5% to 15% that's settled up on a daily basis when things are marked to market. So there's no need for the borrowing situation. So with all that in mind, that's why managed futures tend to work. In a sideways stock market, it is true that managed futures could potentially have a positive return, but that's not what we're looking for. Managed futures really kick in. They really do help your portfolio, or at least they have in the past, when there's been crisis situations where everyone in the market is hurting, looking for the gates, and managed futures, because of the resilience, because of what futures contracts are, have tended to create great opportunities for their investors. I'm Larry Shover, Chief Investment Officer of Solutions Funds Group, with the August 2012 commentary, reporting to you from the CME Group in Chicago.